Good morning and welcome to Bazaar ki Baat. The Indian equities fell for the third straight month in a row, with the BSE Sensex falling close to 0.8%, 0.9% actually, and Nifty 50 falling close to 2%. As has been the trend, the smaller companies continue to lag behind their larger peers. The BSE Small Cap Index fell close to 3% in February. When we look at the US markets, there was a reversal in the trend in February. Unlike January, we saw S&P 500 falling close to 2.5%, Nasdaq showing the same trends. Kshitij, what do you think has been really battering the markets in the last month?
Yeah, so as you can see, I think the selling has been across the board in February. With the smaller stocks, as you said, were the worst hit. As the quarterly results, we will see that going forward, the quarterly results for smaller stocks continue to be bad as compared to the larger peers. So that also kind of impacted the small cap stocks more. Apart from the domestic results, I think the major concern which market has is the global market triggers. Broadly two. One is obviously the Fed hawkishness. Fed, as expected, raised rates by 25 basis points in February. But the real concern is that the commentary post the rate hike from the governors and statement from the Fed governors have been really hawkish. The expectation is now that they made it crystal clear that they will continue to hike till inflation is under control. So they've already hiked around 450 basis points since March 2022. And the expectation is that there will be more hikes. So that is actually pushing the terminal US rates higher. So the expectation is building it up that the terminal US rates may be higher now. Secondly, all these rate hikes will have a concern on the growth definitely. There will be a growth slowdown, and the war has also contributed to a great effect on that. So on both fronts, I think because the rate hike cycle going to continue for a longer time and growth slowdown concerns, the market got better, and I would say to a certain extent these concerns are valid. On the other hand, domestically, if we see RBI also hiked rates, and they have also, I think, taken a leaf out of Fed's playbook that they're also slightly more hawkish than expected, and they will probably so there were earlier market expectation of no pause going forward, but now the market expectation is building up that there'll be a hike even in the next RBI meeting. And to further compound the problems, I think FPI selling continues to a smaller extent as compared to last 2 months. And however, I would say one concern which is slightly have got corrected, which was the reason why we are seeing a downward trend, is the relative valuation of Indian market as compared to its EM peers was actually higher, and which led to some reallocation from India to, let's say, other EM peers of South Korea, Taiwan, Indonesia, which were relatively cheap. Indian market has always been slightly at a premium as compared to other markets. There are certain reasons for it. I think we have discussed it in few months back, because of the diversified nature, and there are certain inherent advantage with Indian market which command a premium, but the premium had actually risen up very sharply in the last year. Overall, if you ask me how do I look forward to it, is that I think I continue to be positive in the medium term. I believe there are places to be optimist about, and there are short-term concerns, as we have already discussed, which will continue to haunt for some time, maybe in the first half of this year, or maybe even after that. But I would like to probably suggest that the investors, or we are also doing that, and investors should use this opportunity to review their investment portfolio and the underlying thesis. Why, if it may be a good opportunity to weed out some of the underperformance.
Right.
On the
So
rate,
seems, yeah. Yeah, continue.
Yeah, that's about it on the equity side. I would just like to add rate as we are very close to the peak of the rate cycle, the duration has again become very positive. We have discussed in few last month meeting also. I think Vikas has touched upon it in the last few meetings. I think it is a good time to lock in rates, be either FDs for senior citizens or target maturity funds for everyone else, considering the tax efficiency nature of the mutual funds over FDs. It may be a good time. I don't think there is a meaningful upside to rates from here on. So it may be a good time to lock in the rates.
Right. So looks like there were multiple factors impacting the markets in the short term.
Mhm.
When we look at the sectoral breakdown of the markets, we see that all the sectors had been under pressure except maybe capital goods and FMCG.
Mhm.
Power, fell very, very sharply. It declined more than 14% in February itself. And also amongst the factor indices, momentum continues to have a bad month. The BSE Momentum Index actually fell close to 9% this month. So before we get into what is really dragging the markets down from a sectoral perspective, can you throw some light on what supported the FMCG sector?
So FMCG sector, I think the biggest point was that better than expected rural sales in the quarter and the pricing power to a certain extent they were able to sustain. Most of the companies have been able to pass on the price hikes in the FMCG sector. But the real uplift of the FMCG sector on the earnings side came from ITC, which has actually given strong results. Uh, Apart from FMCG, I think, as you said, IT and consumer durables, I think that is more of a defensive play. When the market corrects, I think these are the sectors you look at. And private banks have, as if we break up the banking sector, private banks have continued to do well on the back of strong earning results. So yeah.
And what about PSU banks? They seem to have corrected a bit.
Yeah, so PSU banks, I think they had actually run up quite well in the last 1 year. So there's some correction bound to happen. But they got hammered unwarranted to my view due to the concerns of exposure to Adani companies, which if you look at it, most of the exposure is to strong asset-backed companies, and also there are the concern to Adani exposure to Adani companies meaningfully very low. SBI has already come out with their statement that the exposure is quite low. So I don't think the correction on this concern is warranted.
Okay, so from an overall point of view, what do you think has been impacting all the sectors negatively?
Yeah, so if you can see, metals have underperformed this month, largely on the account of falling prices and rising input costs. They had benefited from China reopening, but the concerns of global slowdown have actually impacted the metals market. Otherwise, the other sectors which are rate sensitive, like auto, realty, housing, they are expected to underperform considering the expectation of rate hikes in future. Pharma specifically got hit due to a slew of investigations launched by US FDA into the pharma companies in India. And I think power, I think there was some component of Adani Power getting hammered. And overall, I think also they also suffer from uh, shaky oil prices and power prices. There are concerns in those sectors also.
Mix of short-term factors that we see here. So last month we had a rollout of corporate earnings, and now that most of the earnings are out, we have seen that the aggregate earnings of Nifty 50 companies grew by 18.5% year on year, and this was largely driven by healthy double-digit revenue growth and better asset quality in the banking space. Private banks, autos continue to be the leader of the pack, while commodities continue to be the laggards. Like I said, smaller companies take more of the heat. Uh, Growth in revenue looked decent for smaller companies, but margins have shrunk sharply. So, Kshitij, what is your view on, what is driving the healthy revenue and profitability growth across sectors?
Yeah, so I think both revenue and profitability growth is being driven a lot by banks, and also this quarter autos have supported. So both of these sectors are doing really well. Let's talk about autos first because banks we have already talked a lot about in the previous few meetings. Banks, I would say, margin recovery was the talking point, benefiting from the raw material prices decline, right? So Tata Motors, which was one biggest surprise in the auto sector, is that the company reported positive profit after tax after 7 quarters at 3,000 crore, much ahead of the market's estimate or everybody's estimate. So which has lifted the overall earnings in the quarter for the autos pack. However, the domestic demand in autos and the export demand in autos remains a tale of two cities. So the export demand has actually been quite muted while the domestic demand has picked up. Commercial vehicle space is doing very well. Ashok Leyland gave an excellent set of numbers. Other auto companies like Maruti, M&M, they have been giving steady set of numbers. Now let's as you said, private banks have been doing very well. It has continued to give out strong performance on earnings, largely led by business growth, asset quality improvement. We know that there's a considerable asset quality improvement over the last few years. Loan growth was as healthy as 15% as per the RBI numbers. And putting this all together, NII growth grew very strongly for banks, and we continue to have a large credit offtake. So also one thing which helps bank is that in any rate hike cycles, uh, there is a quicker transmission of rate hikes in the loan or in loans as compared to deposits. So which pushes up their NIMs. So which is also where also banks are also benefiting. Yeah.
Yeah, we have seen loan rates increasing quite a bit in the recent past. But what happened to metals?
No, so I think we've already slightly covered that. They had a bad quarter, largely we have seen an uptick now in the last 2 months on the metal prices, largely due to the China reopening being supportive of that. And maybe this quarter the earnings would be good. Normally, also seasonally, if we see Q4 is the best quarter for strongest quarter in terms of volume for steel company. So that should push the overall metal space have results to a better performance this quarter. Uh, yeah.
All right. Okay. So recently, most of you would have come across the new pension scheme that has been introduced by the government, and we have been receiving a lot of emails, from salaried employees asking what should they be doing. Should they shift to the new pension scheme or continue with what they have right now? So let me invite Vikas to first explain what is the difference between the current setup and the new pension scheme. Vikas, could you just briefly simplify this for our audience?
Hi, Shruti. So, what I have seen is that there's a lot of interest around what is the changes which has happened. This is a landmark judgment because these kind of retrospective amendments don't happen like generally. So, first, I will like to explain what is presently happening and what is the change. So, if you are if you are employed anywhere and if you are contributing to EPF, presently what happens is that 12% of your basic plus DA goes to EPF. In this, there's an employer contribution and there's an employee contribution. Now, the recent changes is only applicable to your employer contribution. What used to happen is that in your employer contribution, your EPS contribution was 8.33% of your salary, which is basic plus DA. But for the calculation of EPS, it was restricted to 15,000. So whatever amount like is 8.33% of 15,000 used to go to EPS. So which was generally for most of the people, it was 1250. Now, but what has happened is that because of the judgment, what they've said is that any person who is who is under EPF before 2014, he can now contribute 8.33% of his salary irrespective of this capping. So now what happens is that you can contribute to your pension account a larger chunk of money which has no cap, and with this you will be eligible for a pension which is central government guaranteed. So this is a very lucrative scheme for a lot of people who want to have a regular stream of cash flow once they retire. So then what happens is there's one more important change that like in the pension calculation, what used to happen is that since your salary was capped at 15,000, when the pension was calculated, it was calculated basis of this formula, which is pensionable salary, which was capped at 15,000. So this was always 15,000, this pensionable salary into your pensionable service divided by 70. Now what happens is this pensionable salary, this component changes, and now this pensionable salary is like your average of last 60 months of your salary. So now what happens is that if you have been employed for 20, 25 years and your last 5 years salary is high, your pension becomes a significant chunk to maintain your retirement lifestyle. So this is the major change that has happened. Other than that, but yeah, one more thing will happen is that because you will be contributing more to EPS, your contribution to EPF will reduce to that extent. So just to give you some ballpark figures, say suppose if you are contributing say 100 rupees total to your EPS, 50 employer, 50 employee, your 50 employee remains as it is. Out of your 50 employer, earlier what was happening is that maybe 2, 3, 4% was going towards EPS. Now close to 30, 33% will go towards EPS and rest 17 will go towards your EPF. So now EPF goes to 67, 68% and EPS goes to 32% for people who will subscribe to this. So before going to the example, what I would like to say is that there are certain things which you have to understand about yourself before deciding on which plan you should choose. So if you are someone who is more certain about working till the age of 58 and who likes regular cash flow and who is not very keen on managing his corpus when you retire, then I think moving to this pension scheme makes a lot more sense for you. But for someone who is who can manage his finances after 58, because there are certain things, there are certain deterrent also if you move to this. So some of the deterrent are is that the pension will be based on last 5 years of your salary. So if you are working in a job where you are downgraded from your earlier job, then your pension will go down. If you want to retire early, then what happens is that your pension will accordingly be adjusted because you have not worked for the last cream period of your employment. Also, in EPF, what happens is the entire money is tax exempt when you receive, but under EPS, what happens is that your pension that you receive is taxable. So these are certain things which has to be taken, which has to be thought through before you switch to either of the schemes. So what we did is that we did a small calculation. We did some hypothetical numbers to ascertain what kind of impact will it have on your pension. So in this example, what we want to show is, let's say suppose if you are earning right now 50,000 rupees per month and your retirement salary we have assumed as 1 lakh. And if your date of joining is 2013, you are eligible since it's for people who are employed before 2014. And in this case, what happens is your pensionable service becomes 33 years. So in the current example, what happens is that if you see the numbers, 6,000 was your EPF plus EPS contribution, 12% of 50,000. And in the earlier case, you were contributing only 1250 to EPS. Now you are contributing 4165. So this contribution, what happens is results in a pension increase of close to 6 to 6.5 times when you retire. So the point that we are trying to make is that there's a significant jump in pension if you move from old regime to new regime of pension. On the other example, what we wanted to show is that, can you change it to the next slide? Yeah. So in the other example, what we want to show is that what is your break-even point? So by this, what I'm trying to convey is that it should make your decision point easier also in terms of your break-even point. So what happens is that in this case, what we have assumed is that your salary is 50,000, which is growing at 6%. And in the first case, what is happening is your pension is 7071, which is your present case, and your EPF corpus, if we assume an interest rate of 7%, your EPF corpus is 1.6 crores. If you move to the new pension scheme, there's significant jump in pension. In this case, there's a higher jump because we have assumed that in the last 5 years of your service, you will be having your maximum salary. So what happens is the jump is close to 19 times. But what is what you are foregoing for taking this 19 times jump is in pension is that your EPF corpus goes down by 1 crore. Now, what does this signify is that if your EPS corpus goes down by 1 crore, 1.1 crore to be precise. So if you are taking this pension for 9-10 years, then only you are able to break even. So by this, what we are trying to say is that if you retire at 58 and if you are able to take this pension till 70, then what happens is you break even, and then maybe your advantage kicks in for choosing this pension over EPS. So EPF. So these are some like calculations that we have done, but we still believe that this advice about switching to pension EPS, higher EPS versus EPF is very, very individual centric. So if you have any queries or if you want us to help you out, you can always reach out to us at contact@cgfunds.com. We can schedule a call or we can run through numbers so that you can get a perspective. So this is from my side, Shruti.
Right. So what I understand, Vikas, is that there is no straight yes or no answer to whether one should move to the new pension scheme. While there are, quantified methods to figure out, what's the trade-off, I personally feel there are a lot of subjective variables also which drive the selection. A lot of people I know who are retired now would have loved a pension because that helps them give the psychological comfort of having a continued cash flow, whereas a lot of other people would want to have that corpus and manage that better, given that they have a higher risk appetite and a better understanding of, maybe money management per se. So, yes, I think we are open to having discussions around that in case you want to have a discussion around whether you should move to the new pension scheme. Feel free to put in a comment on the post or reach out to us on contact@cagrfunds.com and we will be happy to schedule a call. Thank you so much and have a good day.